Hello, disco. Dance with him, why don't you? Oh, revive the mighty disco. Rise again, almighty disco. Woo! How you guys doing? What's going on? What is going on? Well, this video is not about Elliott Wave. It's not about the typical risk on, risk off. It's about technical analysis and fundamental analysis, and we have to combine two. We have to have correlations. We have to have a lot of stuff in the financial market. It's a lot of information out there. It's confusing. But if you combine some information, it makes sense. Why did the market go up? Because the expectation of negative interest rate. Why is that? Because it involves the money, the liquidity. You know, if you have a lot of money, a lot of people would go to risk on high risk investments. Which one is the most liquid one after the forex market? It's the stock market. So you go there. You don't care. The PE is gonna go with PE expansion. You know, because the negative PE. So negative interest rate. So you go PE expansion. You buy and you have a good time, and you expect the market will that the economy will rebound later, 6 months, 8 months in the future. We don't care. We have a lot of money, a lot of liquidity. We could play the market. So this is absolutely makes sense because it's all about liquidity. We don't have to convince the market of our thesis, all that things, but you know, it's all about the liquidity. That's why when you raise interest rate, the PE go down because it affects the money supply. It's a piece of cake, and when you do the opposite happens. So I'm looking at the TLT because I've been watching a lot of news channels. Only one person that talked about it. One of the major analysts, and I talked about it before they talk about it. I'm not trying to pump myself up, but I just thought about it. I did not hear anybody talking about it, so it's just my own thinking. So okay, when TLT go down at this stage, that means the yields go up. Yield affects the interest rate most of the time. Sometimes it leads interest rate. We've seen that in late 2018, when a lot of analysts thought of the interest rate would be 3.5 or whatever. The bond market told us otherwise. I believe the bond market. Okay, we got this out of the way. So when the market go up at this stage after the flush, it makes sense because it's fundamentals. So here, let me do this bad boy right here. Oh no. Okay, so this is the Dow Industrial, the daily time frame, and this is TLT daily time frame. Okay, so it makes sense. They went down together because of the lack of liquidity, you know, and the risk parity gets screwed, and we had a flush, and that flush TLT kept charging on, and the equity market blinked here. But they went down in tandem together at the end of this cycle right here. So we heard the central bank intervened at this point, so they went up together. This is you screwed the risk parity, but it's okay. It's okay because the fundamental reasoning is understandable. So interest rate the yield go down, bond prices go up, and more money supply. So PE expansion, you know, forward PE. There's nothing wrong with that. So you understand the logic now. So we try to figure out the market movement and make sense of it fundamentally. So the PE, the PE expansion. No, whoa, that's nice. So we had the old risk on, risk off. Okay, whoa, they moving together now. What happened? What happened to risk on, risk off? I think I know. This is during the time of the. To me, it's infamous, and that's not really infamous. I'm happy for them. but it gave a false move in the market. The American unemployment was unexpectedly more jobs at this job report right here, and it affected risk off. So we went back to risk parity, risk on, risk off. But after that, we moved together. So, in my point of view, and I think I'm right, TLT at this time, it's like we have in Elliott wave, we have the alternation the alteration mode in correction. Two different corrections don't repeat itself. Like if the second wave is zigzag, the fourth wave would be triangle, flat. So this time, that time, the Dow blinked first. To me, this time, the bonds blinked first, and they're gonna work in tandem later together. After you break important support here or here in the bond market or TLT. So this is my thesis now. It's fundamental. It's mostly fundamental. So I know a lot of people were upset, including me. But I was reading a lot of articles at that time here, and I understood the negative PE and negative interest rate and its effect on PE. So I was okay with that right here. You know what I mean? Now, if you break this low, the negative interest rate theory will go out of the way, and this will affect the valuation of the market, and it will create panic. So I put this thesis out of the way. I hope you guys understand it. I hope you guys know what I'm talking about. I'm not trying to put fear into people, but I'm trying to make sense of this chaos. And I think I'm right at this point. I really do. But I might be wrong, but it's my own belief. So let's talk about TLT. I'm repeating myself like a broken record, but sometimes you have to repeat yourself. So what happened here? You have a bullish engulfing at the major top right here. To me, this is a noise. I'm taking this off of the chart because it's a one-day event. So to me, this is the top right here. Some chartists, including myself, take some blips. This is a blip to me. So this is the real top. So you have a bullish, bearish engulfing at the major top, and you went down dramatically. And this is the alligator strategy, where the 5-day moving average bearish across the major mover averages, the smaller ones, the 8 and they're 13. So according, I'm repeating myself again. I'm a broken record, crazy. And John Bollinger says after this Bollinger Band expands and you close below it, that's a confirmation of a bearish leg. So this is according to that nice, one of the best technicians ever. And I love the Bollinger Band. So this is very bearish right here. And this is the MACD crossover, and it's not backing off. It's really going down, the histogram. So this is the daily time frame for TLT. All right, let's go to the weekly time frame for TLT. TLT here went through a bear flag right here, or bear wedge. Sorry, bear wedge right here, and it broke it with 3 consecutive bearish candles. First one is a quasi hanging man, and the second one is definitely a shooting star that came after you hit the Bollinger Band, and you go to the mean reversion or the lower end of the Bollinger Band, which is almost in a pipe formation, which indicates volatility coming. So you have bearish engulfing and a Marbouzou in the weekly time frame. So it's like 3, 4, 4 and 3, 1, 2, 3, and this is 2. Bearish engulfing and Marbouzou in the weekly time frame, and you closed below all these moving averages, and nice bearish divergence in the MACD, both in the MACD and the histogram. The histogram did not confirm this high right here. So this is the weekly, which is really, to me, This is very, very reliable, and the histogram is going down. So this is the weekly time frame. So usually the target. So I'm not talking about Elliott wave here. I'm trying to just focus on fundamental and conventional technical analysis. Fundamental analysis and technical. So according to this bearish wedge, the target is here, is 153. 153 will create havoc if it happens in the market. Havoc. So okay, so we talked about TLT, we talked about the weekly, daily time frame, and we talked about the importance of negative interest rate to both gold and the equity market. So we talk about now. Let's talk about the put to call, which I really love. Very nice account in Twitter. I think it's sentiment, whatever sentiment indicator. I'm really sorry. I'm not taking it from him, so I'm a put to call type of guy. So I'm just referring to him as he agrees with me, and I love that. I love it when people with really good technicians and good analysts agree with me. It makes me feel better. I don't want to feel lonely. So the gentleman talked about the 50-day moving average of the put to call at almost decades low, and it really is. It really is. So this is the moving average, the 50-day moving average for the put to call. And last low, it was in Feb 18, 2020. And what happened? Boom. It went up. When it goes up, this bad boy goes up, the market goes down. And here is a pivotal place for put to call. Put to call to me measures liquidity. If that means a lot of people are bullish, that means that a lot of people are in the market. So they don't have enough liquidity, they go and buy more calls. This is simple. So the whole presentation here, the whole video is about liquidity. So lack of liquidity via put to call. Okay. So let's talk about the dollar. The dollar, which is to me and to many people, it's the ultimate safe haven trade. And if you check it on your own time now, it's a lot of analysts, a lot of portfolio managers, a lot of big boys are really bearish on the dollar. And this bad boy reverses when everybody thinks it's going to go to heck. And as I said before, three major moves usually result in reversal. First leg, second leg, third leg. You could look it up yourself. It agrees with the Elliott wave, first wave, third wave, fifth wave. But even in conventional technical, a lot of conventional technical analysts believe in that too. After three major moves, you have a reversal. Even though this is a continuation pattern. But as I said earlier, what's going on now is beyond technical analysis. It's about liquidity, and we go to Elliott wave. So according to Elliott wave, we might have concluded the second wave, and we going through third wave, and the low is still on for the last 3 weeks. Even though, as I said, we form in a continuation pattern. Yet Elliott agrees with me, and also the money supply agrees with me, and negative PE and all this stuff, negative interest rate. I'm sorry, and I really wish I can help. I really wish I can help any person. In conclusion, the Dow is extremely bullish. It's beautiful. You could ride that bad boy, but you have to have stop loss, because it's all about money liquidity right now. It's all about money and liquidity. The market makes sense if you try to make sense of it. The market does make sense. The market, the risk parity gets screwed because it was based on negative interest rate. So bond market go down, and also bond market goes up, and also the stock market goes up in tandem. And gold the same thing. So you have this screw with the risk parity based on a fundamental reasoning, which is a negative interest rate. If you don't think about this stuff and you focus on the smaller picture, you're gonna have bad luck, and you don't want to be like Larry David sometimes. And I really love you guys. I love Larry David. I love disco. I love this financial market. I'm happy to be an independent trader. I really want to help. There is nothing wrong with long in the Dow, but please with a very tight stop loss because of money liquidity. I love you guys, and Larry will live a beautiful and healthy life, and disco is forever!